So I'll introduce both of our speakers now, as we have a lot of territory to cover. Nick Timberlake is the Global Head of Emerging Markets Equity at HSBC Global Asset Management in London. He's going to explore the new phase in development of emerging economies with a small group set to take centre stage, and at the same time a new generation of emerging market opportunities surfacing in what he calls emerging frontier markets. Samantha Ho is Investment Director at Invesco in Hong Kong and has 20 years experience covering the Great China markets. Samantha is going to focus on Chinese equities, the opportunities, how to access them, and the performance outlook and risk. So first of all, could you please welcome Nick Timberlake?
Good afternoon, ladies and gentlemen. It's great to be here in Australia. I've been told that I've got 15 minutes to talk, which works out, I think, somewhere in the region of it took me 1 hour for every 30 seconds I'm able to talk to you to actually get here today. But I'm here, and I've had quite a lot of coffee between arriving and now, so hopefully I won't fall asleep in the middle of this, and none of you will either. Okay, so as already mentioned, I'm going to talk about the new world as far as emerging markets are concerned. I just thought it would be a good place to start, just to remind everybody how important emerging markets are in the world. Somewhere in the region of over 80% of the population of the world is in emerging markets. More than 3/4 of the land mass and the natural resources of the world are in the emerging world. Today, the foreign exchange reserves of the world, 2/3 of those are in the hands of the emerging world, a lot in the hands of the Chinese and those countries in the Middle East. GDP is now roughly half that of the world, but the market cap, if you look at the stock market, still just 10% of the world. So we think there's an enormous catch-up that still needs to take place between where the markets are and many other important fundamental factors. So the world as it is now, I think everyone knows the United States dominates the world in GDP terms. It's just been mentioned that China is now the second largest country in the world in terms of GDP, having overtaken Japan earlier this year. And if you look at the top 20 countries in the world, which this chart does, you'll see that 9 of them are emerging countries. There's been lots written about what will happen in the future. Now, this is looking a long way out. This is Goldman Sachs forecasts. And I think the key thing to remember is, with these forecasts, is they're always wrong, but they always seem to be wrong in that they're too conservative. And I think the chances are very high that this forecast, which is looking out to 2050, so still a long way off, it will prove that this picture probably comes to pass long before 2050 is my best guess. So just thinking about the previous page, you can see in this new world order, the world is moving rapidly east and rapidly south, and we go from 9 of the top 20 countries in the world being emerging to 15 of the top 20 countries being emerging. And so I don't actually really like the term emerging markets any longer. I think it really doesn't make sense in this new world, and I think it's more about the old world and the new world rather than the emerging and the developed. If we think about how important emerging markets are, looking back to the 92-95 period, you can see the emerging markets in the bottom section over there, not really being an important driver of world growth, but growing very rapidly. This is the picture today, a very important driver of world growth and continuing to grow very rapidly. I think everyone talks about the US consumer when they talk about the world economy. The US consumer today is valued at roughly $10 trillion per annum. To give you some kind of feeling for how that fits in with the emerging world, if you take the biggest 4 countries in the emerging world, which are the BRIC countries, today the BRIC consumer is worth somewhere in the region of $4 trillion. So somewhat smaller, but growing incredibly rapidly. And to make us maybe a more short-term forecast, over the next 5 to 7 years, it's likely that BRIC consumer will overtake the US consumer, and more on that in a moment or two. I think the emerging world's very well positioned in terms of its balance sheet. Many of you in the room will no doubt remember all of the problems that occurred in the mid and late 1990s, started in Mexico, and then finally finished, having been all the way around the world, in Brazil about 6 years later. And the problems were very similar, in fact, to the problems that much of the developed world faces today. And the key word associated with those problems is debt. And I think the picture here, which shows public debt on the left-hand side and household debt on the right-hand side, you can see a stark contrast between the emerging world and the developed world in terms of the debt levels today. And that gives the emerging world a lot of financial firepower to weather any particular storm which may be going on elsewhere. Now, the emerging markets I touched on at the beginning have many advantages, but one key advantage, I would argue, is the demographic picture of the emerging world. Not only large populations, particularly in the case of places like China and India, but also very young populations. Half the population of India is under the age of 25 today. It's roughly the same in Mexico, it's roughly the same in Indonesia, it's roughly the same in Brazil, and so on and so forth. And these people are seeing rises in their GDP, in their living standards, and they're starting to consume in large numbers for the first time. Small ticket items, if you think about mobile telephones as an example. In India, 3 years ago, there were somewhere in the region of 3 million people every month of the year buying a mobile telephone for the first time. Today, that number is in excess of 10 million people every month of the year buying a mobile handset for the first time. So the population of Greece, every single month, buying a mobile handset. Now, obviously, a mobile handset's quite a small ticket item. If you think about bigger ticket items such as cars, we're now starting to see very strong demand from the emerging world for cars. So in China, I think last year the Chinese exceeded the US in terms of their auto demand. It's running at somewhere in the region of 1 million cars a month. If you look at the penetration rates of cars in China compared with that of the developed world, that's when the story really becomes very powerful. In China today, penetration rates somewhere between 25 and 30 cars per 1,000 of the population. In most European countries and the US, that number is somewhere around 400 cars per 1,000 of the population. So you can see the numbers can double, double, and double again, and we're still nowhere near where the developed world is. If you look at the big auto companies, even the really expensive cars, they see their future in places like China. I'm sure many of you will know about Rolls-Royce, one of the most prestige cars in the world. In their recent results, the chief executive of Rolls-Royce predicted that next year the number of cars they sell in China will double from what they've sold last year, and China will become their second most important market. Urbanization is another big factor linked to this demographic story. And here I just plot the urbanization rates of different emerging countries at different stages in their economic development. And you can see the pattern is very similar, but you can also see that the countries with the biggest populations are still some way behind the curve. So picking China out again, and we're obviously going to hear a lot more about China in the next talk, but very quickly, Chinese urbanization is running at somewhere in the region of 1% per annum, so roughly 1% of the population is moving from rural to urban each year. Now, in the Chinese context, that's a lot of people. That's about 14 million people. That's roughly double the size of London, 2 Londons a year, or in more local terms, maybe 3.5 Sydneys a year are moving into the towns and cities. So that's another really important driver. Maybe just bringing things a bit closer to now, just to think about the asset class in valuation terms, talk about the stock market maybe just for a moment. I think the stock markets look pretty attractive today. We obviously saw a very strong run in the markets after the crisis in 2008, during 2009. So far this year, the markets really haven't done anything, but the valuations, I think, are pretty supportive. Today, the emerging markets as a whole trading on about 10.5 times earnings, or 1.8 times book. Compared with the developed world, despite all this exciting growth that I've described to you, the emerging asset class trades at a discount. This chart, the orange line is the developed world, the red line is the emerging world. If the red line is below the orange line, it's trading at a discount. You can see there's been a steady trend of closing of discount, really going back to 2000. And I think it was at about this time when companies in the emerging world started generating higher levels of profitability than companies in the developed world. That's still the case. It will be the case for a number of years to come. And I think it's likely that gap will continue to close. So maybe a brief moment on some of the new markets. Everyone's very familiar with the mainstream emerging markets. There are 25 big countries, but there are actually another 40-odd countries now around the world which have stock markets, which are maybe exhibiting many of the features of the emerging world, as was the case when I first started getting involved in investment back in the early 1990s. And these markets offer fantastic opportunities. Everyone talks about China as being one of the fastest growing countries in the world, but actually if you take the 10 fastest growing countries in the world, 8 of the 10 are what we call new frontier markets, markets that are outside of the mainstream emerging markets. They're much less researched, they're often less liquid, there are lots of inefficiencies, which is great news if you're an investor in these markets, because it means more often than not there's a lot of money to be made. Some of these markets aren't yet really open to us as foreign investors. Just looking at the list here, Libya is an interesting one. I was in Tripoli about 3 weeks ago, and it's amazing how fast that city is growing at the moment, but there's not much of a stock market to speak of. There is, however, a huge pipeline of IPOs. There's somewhere in the region of 100 IPOs, and I think that market is going to explode in the next 5 or 10 years. So we'll be watching that extremely carefully, and some of these other markets have already started to appear on our radar screens. Most people are not looking at these countries. So frontier markets are even cheaper than mainstream emerging markets. Interestingly, whereas there was a strong rally in most stock markets during 2009, in the frontier world, for many different reasons, which unfortunately we don't have time to go into in my talk, the rally didn't really occur in the same way. I think a lot of people have just decided to stick to their knitting, to stick to what they know since the Lehman Brothers crisis and the recession, and as a result, this asset class has been ignored. And you can see that really with the lack of money that's been coming into the asset class. Historically, it has been quite late cycle, and I think it offers a really quite significant opportunity for investors, given where we are in the cycle today. Just a quick snapshot on the valuations, and you can see, generally speaking, valuations are somewhat cheaper than in the developed and the emerging world. And another interesting point for those of you thinking about diversification, these smaller markets, there is much lower level of correlation in these smaller markets than there is for mainstream. So you can see the red line, which is the emerging markets correlation with the developed world, and you can see that today runs at about 80%. So a significant amount of the market move can maybe be explained by general market moves, whereas in the new frontiers, that number today is only 30%. So significant diversification benefits. So with that, just to highlight the key points, that the developed world will be dragged back by high debt levels for many years to come. The key emerging economies have their own engines of growth now. The consumer is really something that's real in the emerging world. I think if I was here talking to you 3 or 4 years ago, I might have been able to tell you we thought it was likely to happen, but there wasn't a huge amount of evidence then. There is a lot of evidence now. And I think more and more we see trade between the emerging world, which will make them much more insulated from anything that's going on in the developed world. Valuations look attractive, but if you want really attractive and you're prepared to take a long-term view, I'd suggest that you look more closely at the frontier markets. Thank you very much.
Hi, thank you, Nick, for giving us so much information on the emerging market. I'm with Invesco. I'm the Hong Kong China Fund Manager. I started in the industry as an analyst 1989. So I have seen lots of happenings in China, and they have come a long way. As a matter of fact, I would say that China has experienced more crises than any country in the last 20 years. Of course, we all talk about the financial crisis, the global financial crisis. In fact, if you look at Asia, you will find that Asia has been doing much better. The recovery has been much faster than the other countries. One of the major reasons was, yes, we did have the trial run. That was the Asia financial crisis back in 1997 and 1998. Asia spent more time in the last 12 years to replenish their balance sheets, de-gearing, whether it was the governments, individuals, or corporates. Though this round, they are in much better position to survive. In fact, because of that, you look at the data for Asia, fundamentally, we're much stronger. Look at foreign reserve. We have gone to around 4 trillion, much more than all the other countries together, and China accounts for over half of it. Public debt, similarly, with the exception of India, our public debt has been very low, on average 46%, as compared to the other countries again, we are in much better shape. Not only that though, GDP growth in Asia, we actually rebound quickly in 2010. Yes, next year we're going to have slower growth, but still very impressive growth. In China, from 9.8% this year, we think about 8% or above. And all the Asian countries, in fact, are going to do much better than the other big markets, including US, EU, and Japan. Of course, stock market rebound substantially last year, and this year we are facing some profit-taking and correction. So last year or year before, people asked me, can China save the world? My answer was no. But to be frank with you, when I look back, China did help Asian countries. Look at the other markets like Japan, Korea, and Taiwan. They all benefit from China trade. The intra-regional trade did help all the other Asian countries. And thanks for China's domestic consumption. The China government did a lot. The 4 trillion RMB stimulus measures, loan growth, all was helping the economy. So demand in China indeed was much higher, and that helped our neighboring countries as well. So after the full year of 2009, everything back to the right track. You see, no matter it was PMI, retail sales, trade, all the leading indicator pointing you to a much normal situation. Yes, we had our dip, like all the other major countries, but we also rebound quickly, and now we're back to normal. 2009, if you actually look back, exports was a big problem. It subtracted 3% GDP growth from China. And of course, because of the base effect, this year has got to be better. So without doing much, we're going to have a much better GDP growth in China. And of course, in the next few years, that will rely on China's transition period, which means that they are shifting growth from exports to domestic consumption and investment. Lots of people are confused about China's economy, thinking that one moment they are tightening, one moment they are relaxing. So it's so unpredictable. To be frank with you, I think it's the other way around. If you know what the country's major objective is, you will find that it's very simple. The officials have been many times saying that they want to have steady growth. And the target has been 8% GDP growth, steady inflation 3%. In the old days, it was too low, and stable currency. Which means that if they see that the economy is going to be below 8% or 6%, they will start to worry. They will start to have the loosening measures to stimulate economy. Vice versa, if they see that the market is going to have an 11% growth, they will be worrying, so they will start to tighten again. Inflation is another thing that they have to look at. Because China, the biggest problem that they see is, if they have social unrest, they will have problem to control the economy or control the country. So inflation is something that they really pay lots of attention to. No longer that they see inflation will go back to 1.4%. They know that has got to be higher. 3% is something they think is manageable. So if you know the reason behind it, then you will figure out that it's not that confusing. Again, this year, we know that it has got to be better because exports have got to be better because of low base. So now we have started to look at policy normalization. You can't have stimulus measures every year. You can't be growing that fast every year because when you have that kind of crisis, of course, you have extreme measures. But now, China thinks that we are at a much better stage. So in fact, they're doing lots of things to make sure that the market is not running away, meaning it's not overheating. So the new lending for this year has been slower than last year, and they increased reserve requirement ratio a few times already. Not only that though, because there are lots of money flowing around, property prices have gone up a lot. So they have been having lots of property measures to make sure that we are not going to see the asset bubble, like what we saw in US and other countries. So down payment is much higher right now for property purchasing, and they also have high interest rates. And for third home, you cannot borrow at all. Even first home, the down payment is actually 30-40%, second home 50%. So that to avoid problems like what you see in the banking sector in the overseas market. So again, I think things are back in track. What's the next driver for China? Can it be sustainable to have 8% growth for a number of years? That's the question most people ask. First of all, fixed asset investment, again, has been stable. It's back to the previous average. Not only that, we know that if we continue to see fixed investment growth only in the coastal area, for instance, Shanghai, or maybe big city of Beijing and Shenzhen, that is not going to be quality growth. You want the country to have across-the-board growth, which means that now they're going to the go-west policy. It's the inner areas that they think that they need to develop. And they're going to spend roughly around $100 billion on that. So if they are successful, again, I think it's a good news for all of us, because you are not going to see China just to have a few cities, few provinces growing, but you need to see the whole country growing in all areas. Consumption is something that we have been always talking about. In the old days, when you ask about, oh, China have got so many people, they've got to spend a lot. I'm sorry to say that in the old days, they didn't have enough money, they could only barely feed the mouth. Nowadays, they become richer. I'm sure that you see lots of Chinese tourists running around to do shopping. This is a time that they want to enjoy life, to buy something that they want, not only what they need. In fact, if you look at the right-hand side, you see that average wage growth has been around 10%. So imagine these people, the mass market has been growing at 10% wages every year. Yes, they finally can afford to spend more money. This will be the driving factor for China. And China will have no choice but to expand into this area. We do have a few fundamental issues though. First of all, Chinese culture, unlike overseas culture, Chinese love to save. On the other hand is that in the old days, China has this retirement plan, which are sons. You have more sons, you can retire better. But nowadays, with the one-child policy, sorry, your son can no longer support you. When you have parents, 4 grandparents, only one son. So nowadays, they have to think very hard. They will have to save enough money for the retirement plan, medical. So the government understands that not until they build a social safety net, people are not going to spend a lot. So that's why recently you hear lots of the plans for medical reform and of course social security fund. This is something that they have to work on before people will be spending. This is only at the early stage, but do watch out. So this is something that they need to improve before people can actually save, tend to spend. Exports, another swing factor. Again, I mentioned that last year, low base effect. This year has got to be better. But if you look around, you'll find that China no longer only exports to the US or Europe. They're exporting a lot more to emerging markets. Just like what Nick was saying, India needs more handsets now. China has been selling lots of handsets, telecom equipment to India, to Egypt, Middle East, Africa. So the trade between China and the other emerging markets are growing. So this is something that I think will potential China with more upside. Asset bubble, I mentioned that, yes, we're worried. With asset prices going up, wow, year to date, Shanghai, Beijing, prices have gone up a lot. If we continue to see prices go up that way, yes, we may see an asset bubble, but not yet. First of all, gearing is actually very low in China, and secondly, the demand is still very strong. More importantly, is the government knows that that could be a problem in the long run, so they are working on it. The policy I mentioned is aimed to cool down property markets, so to avoid a potential asset bubble. Renminbi, I mentioned that the target for the government is have stable currency. Forget about 10% appreciation. It's not going to happen. Imagine that if they have currency appreciation at one go, it's not going to satisfy anyone. Is it 10% enough, 20% enough, 30% enough? Somebody will still be saying that, sorry, is this still not good enough? So if you cannot satisfy people, at the same time, it may be a risk to jeopardize your country's growth. Why bother? So they would like to have a stable, slow appreciation, maybe a few percent every year. CPI inflation, again, is also important to China. Last few rounds, when they had the tightened measures, it was when inflation got up to 8% or double digit. As long as inflation stayed at 3-4%, it's manageable. China, I know that people are saying that, oh, buying China, lots of risk. The market is like a yo-yo up and down. That's why I urge you to find a good entry point. China, I think, is a long-term growth story. But I also agree that there are lots of hot money coming to China in and out. People tend to be overexcited at the boom time and over-bearish during downturn. And if you look at the valuation table right now, you will find that now we're back to average. In fact, the last few rounds, they were all crisis level. I don't think the valuation is going back to that kind of level unless we have another crisis. So given the fundamental, given the valuation, I don't think it's stretched, but finding a good entry point, which I think now is probably not too bad of a level to get in, is indeed very important. Again, China is a long-term growth story. China is going to deliver 8%, 9% plus or minus there for a number of years, given the growth potential. And if you look at the asset allocation in China, it's also very low. First of all, in 2009, China accounts for 8.3% of the global economy. We know that in the second quarter, it already exceeded Japan. Not far away from now, will be 10% or 11% or even higher. I don't know the timing, but not far away from now. But the allocation in terms of MSCI All World Index was only 2.25%, less than 3%. Again, China is an emerging market. It's not going to have one-to-one. But what I'm trying to say is that with the growth in China, the weighting is way too low. It's going to be over 10% of the global economy, and the weighting in the index has got to go one way, which is up. The timing is difficult to say, but it's not that difficult from 2.25 to 5%. Again, China is an emerging market. I know that it may have some kind of volatility, but the trend looks like it's going to go up, and we have got all the fundamentals to back it. Valuation is not stretched. So I just find that increasingly more people are more interested in the China outlook, basically because China will provide you with alternative investment opportunity and also diversification as well. So, but I urge you, the entry point is also very important, given that investors, even the domestic investor in China, they tend to be very retail-oriented. They rush into buying stocks and during boom time. The best way, of course, now buying China is through the Hong Kong market, given that we have increasing number of Chinese stocks coming to the Hong Kong market to get listing. In the longer term, I do agree that people should look at all asset classes, not necessarily to be the stocks listed in Hong Kong, but stocks listed in China, which means the Asia market, or even stocks listed overseas, like on the Nasdaq, we have got a number of internet companies, medical companies. Some people even question that should we be buying other stocks that with huge exposure in China, like Australian commodities companies? I would not argue with you because Australian commodity companies do benefit from the China growth story. There will be a hot demand, increasing demand from China for commodities. But for direct exposures, of course, it's always easier to buy the right stocks, buying the right portfolio. And there are lots of sectors, for example, consumer sectors, you cannot access unless you buy Hong Kong, China. So again, that's all I have to say about China. We remain pretty positive on China and given the fundamentals and outlook. But again, valuation is extremely important. Entry point is something that we stress on. Thank you.
Thank you very much, both Sam and Nick, for that. While Sam's drawing a breath, we might ask the audience the next voting question, and then we'll ask Nick and Sam to respond to your answers. So if you could rank in order of priority your top 3 concerns about investing in emerging and frontier markets. So 43% are concerned with lack of transparency, 42% political risks, and 27% inadequate legal systems. I wonder if, Sam, perhaps you'd like to comment first.
I understand that there's always been people's concern. Political risk, to be frank with you, we always talk about it. It's still a communist party in China. Although they call it communist, it's more or less a socialist. Sometimes I have to say that I never agree with one political party, but it did work better in the last round. They react much quicker. As long as this political party have the objective, the right objective, and have the execution, I think this is okay. So far, we have less of a political risk than most of the other countries because we have got only one party in China. So which is good or bad, you can be the one to judge. Lack of transparency is something that we have been watching, and I have to say that we have come a long way. That is, we still have the big need for improvement, further improvement. In the old days, when I first looked at China, it was terrible. They were all 70 years old guy management asking me, what are you doing here, kid? We're going to have growth. If we have problem, it's a country's problem. That was the old days. And we are seeing that a big improvement nowadays when we deal with management. Most of them are foreign educated in the early 40s, and they understand foreigners much more than the old generations. So they are aiming for improvement. But if you ask me if there's further need of transparency, of course there is. But we have come a long way, and they're working on it. Lastly, legal system. This is something that's why I find that still investing in China through Hong Kong still gives you an advantage because of the legal system in Hong Kong. When the Chinese companies coming to Hong Kong get the listing, they do have to compile with the legal system in Hong Kong. They will have to compile with the SFC, Hong Kong Securities Futures Commission's rulings. So that's why that will still give people a lot more comfort. It doesn't mean that the Asian market, domestic market, will not be giving you opportunities, but of course, you still have to wait for further improvement.
Nick, would you like to comment?
Yes, I mean, I think I agree with virtually everything Sam just said, but to my mind, there's a gap here between perception and reality in the emerging markets. I think people still have the perceptions which went with the realities of 7, 8, 9, 10 years ago, but actually things have moved on a long way over the last decade. And yes, you know, one can point to examples of problems with all 3 of these different factors, but I think you can also point to problems in the developed world for these 3 factors. And I think the gap between emerging and the developed world is difficult to see in reality today. If you look at companies and the way they report and the accounting standards that they're expected to follow, the vast majority of companies that we're invested in today are following international accounting standards of one form or another. Yes, there are different political systems in the world, and Sam pointed out that the Chinese system is better because there's only one party. I'm not so sure about that, but certainly it is better in many ways. I mean, just imagine if you were a politician and you were able to plan for the next 10 or 20 years, and the minimum planning period that the Chinese work on is a 5-year plan, which they roll every year. That gives them, I think, a huge advantage over many of the democracies where, and if you think about, you know, the US, where are we at the moment? We're back in sort of the midterm election cycle. I think Obama, you know, he had his 100 days honeymoon period, and then everyone hated him pretty much immediately after that. But he was hailed as, so how much is he actually going to be able to achieve? Not a huge amount is the reality because of the political system that he's operating in. So, you know, I think you can look at political risks in both ways, but so maybe we should move on.
Well, perhaps we'll open up the floor.
Carla Babbage from Frontier. I've got two questions. I just wondered whether or not HSBC and Invesco have completed any research looking at the link between strong GDP growth and strong equity market returns in emerging markets, and also whether or not you have a view on whether it's better to go into debt or equity to capture this strong GDP outlook.
To answer to your questions, like GDP, sometimes we would have thought that GDP should be reflected in stock market or return in equities. But then I have to say that in the old days, it wasn't the case, because if it would have been the case, then China would have given you wonderful return for the last 20 years. To be frank, if you have go back a little bit history, China has been having 8% above growth for a number of years. But for the first 10 years of strong growth, they never deliver earnings. Again, back to the question is that they had a different agenda at the beginning, because at that moment for them, the Chinese government was to have every mouth feed. So which means that they didn't care about earnings. They care about productivity, they care about output. So because of that, the focus was different. Yes, they could have 8% growth, but they couldn't deliver in terms of earnings. It was only in the last 5 to 10 years that we have started to see that the government finally realized that if you do not deliver earnings, if you just keep on having just productivity but not delivering numbers, and people are not going to invest in you. And plus, in addition, there are more people, they have more educated, they finally realize that they want to make the life better, so they want to make more money. So it was only in the last few years that you could actually achieve that kind of return from buying the right companies, getting share the growth of China. It wasn't the case when I first looked at China. In terms of doing companies research or maybe doing sectors, I mean, that's been shifted from in China. Again, even though I said that political risk is probably not that of a problem now, but we do have to look at policies. For example, for anybody, you would say no-brainer, you should be buying power company because they have, I mean, if a country is growing, you have got to have more power generation, which is wonderful, right? But if you bought power company, you would have lost money in a big time in the last few years because of policy risk. Again, they would let coal prices going up because according to international prices go up. But they would not allow you to increase tariff because of afraid high inflation jeopardizing normal needs of the people. So power company was losing money for a longer time. So again, when you actually do this kind of research, you have to be understanding the policies and how would the company policy will be affecting earnings. And eventually, earnings is something that we have to look at, how they can deliver earnings, and that's how equity return should be reflecting the earnings.
Maybe I could just add a couple of things. I think it's an extremely pertinent question. And I think there are many misconceptions about the emerging world, and I think this is another classic. If you actually look at the key emerging markets and you look at the returns those markets have achieved over the last 10 or 15 years, and you plot GDP growth against returns, what you find is a random scatter. And in fact, at the extremes, those countries which have grown the fastest have produced some of the lowest returns, and those countries that have grown the slowest have produced some of the fastest returns. So using GDP growth on its own as a guide to how the markets will return, I would suggest is a very bad way of doing it. It's a good starting point because I think, as Sam mentioned, there's a clear link between GDP growth and potentially the growth that companies can achieve. But actually, if you look at what's driven returns in the emerging markets over the last 10 or 15 years, what you find is it's so simple, it's valuations. If you had simply bought the cheapest companies in the emerging world and then rotated out of those companies back into the cheapest once a quarter, once every 6 months, even once a year over the last 10 or 15 years, what you would have done is beaten most of the professional managers out there. If you add to that, looking at the returns that those companies are achieving, so some measure of return on capital, again, you find a strong alpha signal in return on capital in the emerging markets. And if you combine return on capital with valuation, you get an even stronger alpha signal. So I would suggest for anyone who's thinking about what's the best way about about investing in these countries, you should invest in the cheapest companies relative to their strongest returns. So and you might think, well, that sounds a very challenging thing to do, high return companies with low valuations, but actually it's quite commonplace. There are many high return companies with low valuations in the emerging world. On your second question, I'm not really an expert on the fixed income markets, the emerging fixed income markets, so I'd be slightly nervous about commenting on that, but maybe just to say that I think a lot of the return that's come from the emerging fixed income markets has been a contraction in the spreads that emerging markets have had in terms of their risk premiums over the last decade or so, and those returns have been spectacular. And also with falling interest rates and inflation. If you remember back to the mid-1990s, we had high inflation everywhere, hyperinflation in some places, very high real exchange rate, real interest rates rather. That situation has changed dramatically over the last decade or so. Now we have much lower levels of inflation and interest rates, and I think returns from fixed income maybe will be less correlated than they have been in the last 10 years, in the next 10 years, and I'd expect maybe better returns from equity markets than fixed income markets.